Hello everybody, welcome to TraderMerlin Show for your Wednesday afternoon edition. Happy hump day everybody. Hopefully I got to see some of you. I saw some of the names here at the Symposium we did today for Online Trading Academy. It was actually a great time. Shout out to Jordan Matthews, Scott McCormick, Darren Komodo, Gregory Theonis. It was fun. It was fun to see different perspectives. And one of the reasons that I love teaching for Online Trading Academy and being a part of that community, as I know many of you are, is you just get to learn from other people. You know, here's somebody like Jordan Matthews who was a student of OTA and then went on to apply it and just done very well for himself, and just a very articulate messenger, a way to convey education. And I learned stuff from him, even though I've been doing this a lot longer than he has. You still learn pieces by watching other people and how they apply the craft. So hopefully that's part of the reason you guys enjoy coming on this show, is the ability to learn not only from me, but from the other guests in the program, and hopefully shorten your learning curve. So hello, Les. We got Alex, Giselle, Big Eb, Dana, Chris, Mario, David, Mimi, and Ivan. Good to have everybody with us for your Wednesday afternoon edition show. Now, I'll start things off. I guess I'll just start with the splash screen, which is this bad boy over here. We're going to do pretty much open Q&A. I didn't have a ton of time to prepare a topic for today, so I just went in the mailbag and grabbed a few questions, and we'll just take it from there and see where the show goes today. So hopefully there's some good stuff along the way that you guys bring to the table as well. Yesterday, we looked at that chart of the Russell 2000, the IWM. And I had that one all mapped out. I made a nice trade on it, and I was mentioning or talking about that one today, kind of what the follow through was and kind of how that trade was planned out. And I think it's important, the math behind it. And I've had a gentleman over the years who we had a falling out about in 2017. He said I said something that I don't believe I said, and we just were two stubborn, bullheaded people, and we couldn't come to an agreement. So he responded with this today. He says, the problem with the hammer bottom is managing risk. Taking a stop below the wick of the hammer is too much risk unless you do a Bob Dunn and take a fixed number of ticks, and will be willing to get in a second time if you get stopped out. So I wanted to address this one because I don't recall me yesterday saying anything to the extent of my stop loss being below the low of this tail. And I agree with Dennis here. It is too big. Oops, I moved the yellow box. The yellow box has been moved. Let me put it back where it should be. Box goes back where it belongs. All right, I'll put it right there. So if we look at yesterday's candle and evaluate where the stop loss should have been, it's important for me to analyze how much risk is in this one. So if I put the stop loss below this candle, was at 211. Well, remember the entry was above. So, you're looking at an entry it's considerably higher than that. This is where you start to take on, I think it was 215.45, I think was my number. I can't remember off the top of my head, but I think it's 215.45. I'm not going to risk, over $4 per share on this one. It may be appropriate in some situations, but not all. So there's the textbook belief is, you put your stop loss below the low of the tail, right? So let's move it over here. We'll play hard right edge. Unfortunately, I have all these little stupid things in the way. Let me, I can't move that one up, can I? There we go. Now it's going to move with me. Anyway, they say put your stop loss below this tail in most traditional technical analysis books, but that may not be appropriate. In some situations, the tail may be enough to incorporate your stop loss, but if I recall correctly, yesterday I was talking about ATR and using ATR to establish your stop losses. So that's how I do it. So if you're going to go after me, make sure you know what I said, because I did not say use the bottom of this tail. That's a traditional textbook analysis method that some people do. It can work, but again, you're taking on, it may be too much risk. Not in all situations, but maybe too much risk for that specific trade. Now, in this example, would it have been too much risk? Well, let's see. If my entry price was $215.45, down a little bit more, put it right there, and I'm trying to incorporate in that lower low of below the tail. That means my stop loss has to be somewhere down here at call it 210.84. Well, that means I'm looking at a $5, I'll call it a $5 stop loss, right? So you got a $5 stop loss in this one. Is that appropriate? Well, I can't make that statement by itself. I would have to go out here and do some analysis. So let me go and add on. We had average to range on here, but I think I took it off. So let me just add on average to range, and we'll see what that looks like. There we go, average to range. That's on the chart. And right now, the average true range is saying it's moving about $4.73. So let me ask you guys, would a $5 stop loss be appropriate for something that has an ATR of $4.73? Right? Would that be an appropriate one? So in this example, the answer is yes. The answer is yes, because it's moving $4.73. The objective should be to have your stop loss slightly higher than the ATR of the time frame that you're trading on. Now, that said, I, for one, was not looking on the daily time frame here. When I was making that trade, I had on a much smaller time frame, 15-minute time frame. So now all of a sudden, that trade, which broke above right here, the ATR at that moment in time was about $1.08. Huge difference here with regards to ATR, but again, it's tailored down to the individual, the time frame that I'm executing my trade on. So wanted to present that because I know some people would look at this and say, oh, well, you'd had a $5 stop loss on this one. Well, yes, if you did it on the daily and that was your longer term swing, yes, a $5 stop loss was appropriate. You want to incorporate more than the ATR. In my case, since I was on a 15-minute time frame, I was looking at $1, right around $1 for the ATR on that one. So a way for me to define risk. And the easiest way to fix that, if you look at that equation, you go, man, a $5 stop loss, that's too much. I don't want to risk $5 per share. Well, then just cut the number of if you have, let's say you have a $100 stop loss. You have a $100 stop loss and you have a $5 stop. Well, how many shares can you trade? 20. You can only trade 20 shares. Okay, fine. Instead of trading your normal 100, maybe you trade 20 shares at that time. So there's always that equation of how many shares I'm going to trade, what is the stop loss amount. What's more important for me from the initial calculation is what is the stop loss amount per the time frame that you're trading. Again, if you're a swing trader, you might be using a 4-hour time frame or an hourly. If you are a long-term investor, you might be using the daily or the weekly time frame to help establish that stop loss. Once you figure out what time frame you would like that stop loss to be on and what you're willing to accept, then you move on to adjusting your share size and position sizing appropriately so that you don't get, caught holding the bag on something that's way too big for you. So I wanted to get that one out of the way. And the second part of that question, he says, unless you do a Bob Dunn and take a fixed number of ticks and be willing to take it a second time if you get stopped out. I'll make this one very clear for me. If I take that trade on IWM and I get stopped out, I don't get back in. There is no second shot for me. Remember, the whole reason that I'm trading this specific pattern is I'm looking for follow through from this hammer, right? And it could be a shooting star if it's upside down, but I'm just simply looking for follow through on this pattern. So if it breaks through and starts to follow through, awesome. But if it comes back down, then to me that follow through is gone. The momentum isn't there anymore. I'm not going to go after it a second time. So maybe I can help with a visual explanation of this. Oh, I did fix my drawing board screen, so I'm happy to say I fixed the drawing board screen. Let's insert a new slide, and I'll leave it right there. Grab my pen, and I think I can go to here. So in this situation, if we have a hammer pattern over here, and we'll just make no. Gosh, why does this? Even though I have it, it just seems like I can never get it to work right. So I've got this hammer pattern here, right? Let's just say this is IWM yesterday, and I got my entry price right above it. So what happened yesterday is it opened up here, sold off. That's still in play for me, right? Still in play. Now, if it rallies back up and then breaks above that high, that's the trade I'm making. I'm taking that trade. And let's say I have my stop loss here, put some dash lines. That's your stop. Okay, and this is your entry. So in this situation, if it did move up and it ends up moving back down and stops me out, am I willing to take it again if it comes back up here? For me, the answer is a hard no, absolutely not. I'm done, right? Once this stop is achieved here, nothing else really matters to me on the right-hand side of that chart because the hammer formation has played out. That momentum that I'm looking to capitalize on, that's a closed picture. It's over, it's done. I'm not going to take a second chance. Now, that's simply my rule. I know that a lot of you are going to have different rules, right? Oh, I know. Sorry, John. I wish I had more for it, too. Oh, I'm sorry. Thank you. Jeez. There's the drawing. Thanks, Mario. I had the chat box covered up, so now you're looking at a You're looking at a bad picture. I'll do it again just so we make sure we have it. So again, here is the hammer pattern. There is the break point right at the top. I know it just showed up. Sorry guys, I was spaced out. I had a PowerPoint over the window which has your chat. So there we go. Now I see you have the chat. The point I was trying to make is if you set your stop, let's say down here, and I'm using this as my entry. Remember yesterday on IWM, I was fortunate because it actually opened up higher, which alerted me to it, but that wouldn't have made the trade, right? I needed to be down below this. So as it came to here and then did this, that's the entry, right? So if it moves up, awesome. If it stops me out, fine. In this case, what I think Dennis is alluding to is, well, what happens if it does this? You know, are you going to take it the next time? No, right? From here on, everything to the right of that, everything to the right of the stop loss is done. That I won't even look at it anymore, unless there's some other trade intraday that looks good, some momentum trade or something like that. See, and Walter, I love it. I'm glad you put that in there. Walter says, I will try one more time because sometimes the second time works, but no more than 2 tries. And again, there's nothing wrong with that. There's nothing wrong with saying, hey, I give myself a two swing rule, right? For me personally, 1. And it's just, I don't know why. Maybe I'm stubborn. It's just the way that it is, or the way that it is for me. But for somebody like Bob Dunn, maybe it is 2 tries. Maybe, you know, for Walter, it's 2. Maybe for John, it's 3. Who doesn't make a difference to me. It's all what your rules are. So for me, it's a no, not going to happen. It's kind of, in my opinion, that situation I just showed you, it's pretty much like if you have a demand zone and the demand is broken and then price goes back up, is that demand zone still in play? I don't believe that it is. And that's just my belief system. I am not right, not necessarily right about it. That's just how I view it. So, let's see. Question from vertical spreads. I don't do vertical spreads, John. Unfortunately, not my thing. I'm not a spread guy. Doing 0-day expiration vertical spreads on SPX. I noticed the spreads deep in the money are paying more than $5 premium. Would those be guaranteed winners? If taken expiration? Not necessarily. There is no guarantee of anything, and your risk there is that you get a real dramatic swing in one of those legs of that spread. But spreads are not my thing, John. Unfortunately, I can't give you more clarity on that. I don't do them. It's stupid of me not to also. I should be doing spreads. All right, we get to block another. It's Block a Russian Day. We kind of do this all the time. Let's see. Hide user on this channel. There you go. All right. Got rid of him. Okay, so I hit him, but I guess I got to remove that message. There we go. The Russian has been blocked. All right, so let's real quick talk about what happened out there today because it's huge for tomorrow. If you guys notice over here on our CPI numbers that came out today, we were slightly higher than expected, and this is Consumer Price Index. We were also higher on the core, which strips out food and energy. But what's noteworthy here, you'll notice the last 3 readings we've had, last 3 months, it has been higher than expectations. So the expectations are this little, I guess, gold band here, or orange line, whatever you want to call that thing. We've been higher than that the past 3 readings, actually 4 readings, which is not a good sign. If you look at the numbers that are coming out tomorrow, we actually have PPI numbers. So if the cost for you and I are going up, what do you think is going to happen to the price at the producer's end, right? We're paying more. Most likely, the producer's prices have been going up as well, which is what's pushing the consumer price numbers up, which of course is inflation. So that number comes out tomorrow at 7:30 a.m. Pacific time, so make sure you guys are aware of that one. We'll cover that at the end of the show today as well. So let's go into, was there any other questions on candles, right? I could explain more about candles. I know that some of you have asked through emailing me at TraderMerlin.com, which I would encourage you to do. Send any questions anytime you want, and I can get to those on that channel. If you have something you want me to go over on candles right now, is the time, because I'm going to move on to a question from Mario, and also turn on my light, which apparently light is not on. All right, so Mario says, with rates anticipated to rise this year, it is expected that banks will do well as their earnings increase. However, doesn't their cost of borrowing also rise, thus offset the increase in earnings, resulting in a neutral position for their bottom line? No. Well, yes. Okay, it does rise. The challenge is, I feel much better with the light on. The challenge is, or the benefit to banks is when rates are at dead low, at the rock bottom, there's no margin, right? There's no spread for them to play with. But as rates increase, now the spread gets a little bit bigger and they can do more with it, thus potentially earning more on those specific bonds or loans that they're making. So the higher rates go, the more wiggle room banks have on those, more they can negotiate in the marketplace, maybe get higher rates from customers, etc. So that is the reason that you tend to see the earnings for banks do better when you have a rising rate. Now, this came up in the Symposium today, and it was, if you look at a rising rate environment, which is not necessarily the death blow for the financial markets, right? It'll continue to go up until it doesn't. So even though we see rates rising, that's expected, and the short of the yield curve will start to rise as well. Not that big of a deal until it is a big deal. And I know it sounds so stupid and simple, but keep it simple like that. We'll know when markets start making new lows. When they start making lower highs and lower lows, then all of a sudden you can say, okay, I can now potentially position myself for shorts in the overall market. That said, if the market drops 20%, as I've said, I think it'll drop 20% this year and then bounce back up to, some double-digit losses by the end. If that happens, do you think that financials are going to be, safe from it? Of course not, right? They might make good money, but they're still going to get dragged down with it. I think that a lot of, pretty much everything in the marketplace will drop if the equity markets drop. There's very few safe havens that rally up in times of despair. Even things like consumer staples, right? Our toothpaste, our toilet paper, things like that we're not going to give up. If the markets crash, they still, Kimberly-Clark, Colgate-Palmolive, still is not going to have, a 20% year if the markets drop 20%. They might hold their value a little bit better. So if the markets drop 20%, maybe Colgate-Palmolive only drops 10. Bottom line, at least from my perspective, is I'm not looking for the prettiest market segment to invest in long when markets crash. I'm looking for the weakest market segment to short the hell out of when things are crashing, because that's where the pain point's going to be. That's where the most decline is going to be. So I might be different than a lot of people out there with my approach to it, but I'd rather not try to go long on the market in any sector if things are dropping. Rob L says, how will this affect silver? Well, in theory, it should be driving silver up. We saw a real nice move up today in silver. I'll bring up gold and silver. But the gold chart, I'll start with gold. Now, gold has been really interesting. We talked about doing spread trades, for those of you who are spread traders, on, let me hide this. Actually, let's just get rid of ATR. We talked about spread trades on the Russell 2000, which Tom, who's taking an options class with Larry today, he's doing spread trades on the Russell 2000, as he should, because it's been sitting in this sideways channel for so long, and this is a daily time frame, and this is huge how long it's been in this channel. It actually does a pretty good income generation. Most people can't make money when things go sideways. With options, you can. Well, if you look at what's going on with gold, you've got an equally pretty picture, right? As it gets near these highs, short it or start doing spread trades on it because it feels really compressed. Now, the general thought for Rob and others, including myself, is the inverse relationship should be here. If markets sell off, we should see gold start to rally. And why is that? For a couple different things. Number one is if the markets sell off, generally what we're going to see is a stronger dollar, because the Fed is retiring dollars, meaning they're taking it out of circulation, which means we have less money supply. Therefore, if demand stays the same, price goes up. So that's the first part. Once you have fewer dollars, that means the dollar is going to rise in price. And since we have a strong dollar, you can potentially go out and buy more goods and services. Now, the only damaging thing here for commodities is commodities are priced in dollars. So most commodities are priced in dollars. So if someone's trying to buy gold and it's priced in US dollars and they're in India or the European Union, they have to convert and buy dollars, and they can buy less gold with their money because the dollar is gaining strength. So that's the only real negative side I see. But historically, you're going to see some pop up because of inflation, because it's a tangible asset. That's the general belief. It just hasn't happened. Now here we have SLV. So there's gold, and I'll bring up SLV, which had a nice little move today, about almost 2%. It was good. I put my target on here. I meant to put all the targets that I mentioned on our kind of New Year's show, where I think we'll be by the end of the year. To 2350, I don't even think it's that aggressive of a call. I think if we really start to see this inflation continue to rally, then silver should start to get its legs this next week and maybe even the next few weeks and rally up to 2350 by February or March. So I think you could see that thing start to really move here in the short-term future as this inflation starts to get worse and worse and worse. So that's how it should affect silver. It's that flight to security, that tangible value. Gold, silver, metals tend to do well, but at a certain point, if that dollar continues to rally, it could hurt them as well. Let's see. Yep. Thanks. My pleasure, Mario. Lori says, expecting a drop sometime, how much percentage of your portfolio do you keep in cash? It all depends on the day. I tend to be more of a swing allocator, so I have stuff allocated all the time. Like right now, I still have some QID. I have some shorts I have some shorts on Facebook. I have some shorts on what did I get? Snapchat. I just hate. I'm revenge trading Snapchat from the loss I had a couple years back. But I would say right now I've got about 50% in cash, waiting for the downside. So again, it's up to each individual. So there's a question that came in after, said, "What's your preferred vehicle for a downtrend, puts or inverse ETFs?" I guess that's the $1 trillion question, right? There's all these different vehicles. Number one would be that you simply go out and start shorting stocks. But the problem is that takes up way too much capital, right? To go out and short 100 shares of Microsoft, I need 30 grand. Right? That's just way too much. So that doesn't make sense. Plus, you may not be able to short, depending on your brokerage firm. So now do you go in and look at things like QID, right? So let's go look at QID. Right, here's QID. This is an ultra share. So this is double short, right? So you got QID. That's a pretty powerful one if the markets start to sell off, but it's, markets have a rally like they did today, well, this is going to end up losing. You could look at things like SDS, which is another, I think this is a double, this is double short S&P 500. So these are vehicles you could use. The problem is the longer you hold them, they'll start to lose a little bit of value every single day. They just bleed out, and part of the reason is just the way that they're balanced. It's done with a derivative, so it has a slow bleed out. So the longer you hold them, you'll start to see it impacting your portfolio. So that's option number two. Again, the problem I have with this is it still requires a lot of capital. Well, granted, it's only $7, but you're still outlaying a lot of capital. You could also go out to your futures markets and go out and start shorting the S&P futures. So there you go. That's another way, which is going to give you more leverage, right? You can get roughly 10 to 1 depending on which futures contract you're looking at. So you could be selling that. There's no short tick restrictions, so you could do that. And then my personal preference would be options. The only problem with options would be your time frame. So if I went and bought SDS, which is double short the S&P 500, I could hold that forever, right? I don't have to worry about my timing. If I buy, let's say, puts that are 90 days out on the S&P, well, the first 60 days I'll probably be okay. Those last 30 days of the option, the value is just going to disintegrate out of those unless it's in the money. Your time value the last 30 days really starts to decline aggressively. So if all of a sudden the market falls in 4 months, but I have a 3-month option, it doesn't help me. And remember, the further out in time that you buy those options, the more you're going to have to pay for them. Right? It's time premium that somebody is selling you. So I would prefer options, but you really kind of have to have your plan in place and feel like you're right. Trust me, I've been wrong a lot with options, as you guys have seen. Rob puts SQQQ. That's the triple. So here's SQQQ. This is the Ultra Pro short. All right, so this is a triple short vehicle for the NASDAQ 100 here. Again, if you're in this one, you better have a strong conviction this market's going to take a nosedive. Again, the longer you hold this, the more it starts to bleed out. But we could very quickly see this thing spike up. You could get some great rates of return on triples. So, NJ, you saw the Spider-Man movie? I hear great things about the Spider-Man movie. I don't know why. Everyone's raving about it. I'm like, is it really that good? Spider-Man? Really? Come on. So, those are the ways that I would trade it. Personally, my first go-to is going to be the options. I'll be out there looking to buy puts, and I'll buy puts, and if it continues to drop, unfortunately, we had a situation in 2020 where I was buying puts, and it actually did drop. There was one point where I actually had a really nice profit, but then it just started to pop real aggressively. Unfortunately, that's just a a problem I had at that moment in time. As the market drops, the premiums are going to get more and more expensive, as Big Ep says. When the market dumps, premiums soar. Exactly. Which is why it's nice to have 90-day options. That let's say you buy a 90-day option window or 120. If all of a sudden after 10 days, you have a real sharp move like a 10% down day or something, the premiums for that option are going to be off the charts. You may as well just dump it, get out of it, right, and take some nice profits on the premium spike. Cool, Chowski, bought some Bitcoin today. Nice. I bought some more at 42 and some more at 39 and change. So we'll see. I'm on the fence right now. I'm not sure which way this thing's going to go. It feels like it's going to go down to 30,000, to be honest. What else? Okay. So, Lisa, you liked it too? I guess I got to go see it. I never really liked the franchise. I was more of the Iron Man type of guy. Cool. So, I guess that was a long-winded answer to Mario's question here, which was really talking more about finance and the banks, and then we jumped into some questions that sidetracked here, talking about shorting, which that's how I'm looking at it, and I'm hoping, I was really kind of waiting till next week, and I was anticipating maybe starting to build a short position on the markets, but still waiting. I do think that the way it's positioned to go higher. It's positioned to do what least people expect it. And right now, it seems like everybody expects this market to sell off, which means it's going to keep going higher. So I'm kind of cautiously watching that. That's kind of why I was looking at that IWM yesterday as a bounce play, because it seems like we might get one more challenge at those all-time highs. A nice blowout attempt, get yourself a bull trap, and then all of a sudden come crashing back down. I hope. All right, what else do I have in here? I got some chats coming through. Everyone on me said Spider-Man was not good. It's weird. All I've heard was it was amazing. I'm like, what? Okay. And I see Michael Saylor. Lisa wants to know about MicroStrategy, Michael Saylor. So, you look at what ways that people make money. It's kind of funny. Michael Saylor was he just posted a picture on his Twitter feed of him at McDonald's. He used to be a McDonald's employee. He looked like exactly the same, just younger. So, MicroStrategy, what they're doing is, as you can see, they've got a fairly lofty share price. They are selling debt against the company. So it would kind of be like, let me just do a personal example. So let's say I ask you, I say, hey, loan me $100,000. Loan me $100,000 and I'll pay you 6.5% interest. And I'm good for it, and I'm a family friend, whatever. And all of you know that there's no bank you're going to go to, not one bank in the entire United States of America that's going to give you 6.5%. Now, if you knew me well and you knew I was good for it, would you guys loan me $100,000 if I paid you 6.5% per year? And it's 10 years. It's a 10-year loan. How many of you here would loan me that money? I'll wait. And if you don't say yes, I'm blocking you. No, I'm kidding. That's essentially what Michael Saylor is doing. He's saying, hey, I'm MicroStrategy. I got this big company. We've got a bunch of cash reserves. We're doing well. We're doing this. We're doing the other thing. We need money. So we're going to sell bonds, and we will sell those to you and pay you 6.5%. So in this example of me personally, let's say I now get that $100,000. What I'm going to do in this case is go buy $100,000 worth of Bitcoin. Because statistically, since 2009, when Bitcoin was created, it's moved up about 150% per year on average, right? So you're getting a good deal because you're getting 6.5% on your money. I'm getting an amazing deal because I'm paying 6.5% to make 150. So really, I have 143.5% profit in my pocket, paid for by you. Gallo's like, nope, I ain't selling it. That's it. I'm blocking you, Gallo. Yeah, do your research, right? But you guys see the analogy is very simple. He's using his company and he's saying, we are issuing debt on behalf of the company, so we should be good for it. We have assets, yada, yada, yada. And he's issued a lot of debt. But he's taking it and he's buying Bitcoin. I think their average price is something like, I think he said 28,000 or something like that. So you'll notice that the price chart of MicroStrategy is starting to look more and more like the price chart of Bitcoin. So here's MicroStrategy. And let me bring up Bitcoin here real quick. Where is it? BTC, where are you? You notice this pretty much this whole curve here looks just like MicroStrategy. I'll bring up MicroStrategy again. All right, so they are basically becoming a proxy. So if you wanted to buy some, buy some Bitcoin, but you don't want to actually buy Bitcoin, well, you could buy MicroStrategy. Chowsky says, that's too low. I want 10% or more. Hey, even if I got it at 10%, even if I loaded to at 10%, it's still a great deal for me as long as Bitcoin goes up. So he's in a situation now where Bitcoin's been dropping, right? Dropping rather significantly as well, I might add. Back here, his company had a huge price point when it was at 69,000 bucks. Then all of a sudden, dropped significantly. So, Lisa, he says, smart move. It's an interesting move. It's a very interesting move because he's doing two things at the same time. Number one is, and by the way, if he's right, MicroStrategy could be one of the most valuable companies in the world. It sounds absurd that could possibly happen. But remember, if he's just buying Bitcoin, thousands and thousands of Bitcoin, let's see what he's got. Let me see real quick here what he has in his portfolio. MicroStrategy, Bitcoin holdings. So right now they have 124,000 Bitcoins. Woo, man, 391. We're like, I just want the one. You can see here, and this was recent. This is as of December 30th. He purchased 1,914 Bitcoins for 94 million. So he's basically taking this money, buying more Bitcoin with it, and let's see if it shows their average price. He was showing his average price before. Okay, so he's got an average price of 30,159. Right, so it's kind of smart. It's a crazy plan, but if it gets down below this 30,000, he's in deep doo-doo, right? He's in real bad shape. Alvin says, how does one make money on YouTube? You get subscribers and you advertise and do all that stuff. Do I get paid for doing a show? I do not get paid. I have not turned on monetization. I could turn on monetization, but then I would just torture all these people with ads. Remember, one of the big differences between what I do and most YouTube channels is this is all live. Most YouTubers, they record a video, they make it look picture perfect, no mistakes, whatever, and then they upload it and they get advertisers to pay for that. This is just a live show I do, so I decided not to run ads and torture the people out there just to make a few bucks. So, but you can. I mean, if this got up to, I think when you get up to like 100,000, that's when you can really start making some money. But to make a couple $100 a month, I don't want to torture the viewers here. So there we go. Could MicroStrategy be a poor man's way to get involved in Bitcoin? Yes. That's kind of what I was getting at, Les. Yes, I do believe so. It's just there's a little bit of risk there. Right now, if you look at MicroStrategy has got 124,000 Bitcoin. I mean, that's monstrous. I believe they said it on that previous screen that the valuation, they just bought it more at 49,000. I think they're looking at, as of December 29th, they have $3.75 billion at an average price of 30,000. Well, you guys remember my forecast for 5 years. My forecast for 5 years is that Bitcoin's going to be $1 million. Now, basically what that means is a multiplier here. So all of a sudden you find their market cap is, the value of their holdings could be several $100 billion. Right? That is it's interesting. He's one of the more radical people in the industry, and he is all in. Right now, you're looking at Bitcoin at trading at $44,000 a coin. Okay, well, there you go. Oh, Big Ab, thanks, man. Thanks, Big Ab. I appreciate that. So, Alvin, that's the other way you can get paid. Is if people do the little, I don't know what they call, super chat or tips or something like that. There you go, you guys. Who spurred this? I paid Alvin $10 to say that, guys. No, I'm kidding. Thank you guys very much, Big Ab, NJ. I appreciate that. That's very nice of you. So there you go. That's your Michael Saylor. It'd be interesting to watch him. If you watch him on YouTube, you can go. He does a lot of interviews. He's kind of crazy. He's a little off his rocker. Basically, his argument is that Bitcoin is digital energy. I disagree with that because it's kind of hard to put your Bitcoin into a car and turn it on and run with Bitcoin. Yeah, anyway, we could do a whole video on a show on how he perceives it to be digital energy. Anyway, there you go. That's your Michael Saylor. Hopefully, I answered that one, Lisa. Let's see. Let's go to this one from Jennifer. So, can you look at Starbucks today? I've held it for years, and I did look at Starbucks today. SBUX. Let's bring that up for the viewers. Starbucks is the perennial favorite, right? It's one of those ones you kind of feel like should be in everybody's portfolio because America's addicted to coffee and just sapping it up. And I don't really drink coffee myself, but I know a lot of people do. So for Jennifer, if you look at what's going on with Starbucks right now, you are at a very interesting point. You got two choices. You either put a stop loss just below this demand zone, which is not even a strong demand zone. It's just this low that we achieved back here on October 29th. It looks, for all intents and purposes, like Starbucks is going lower, right? That trend, that uptrend had been intact for quite some time, ended in September of last year, right? You broke the upward trend line. You are now making lower lows, lower highs. So it looks to me like this might be headed lower here going forward. So, if you've held it for years, I guess this is more of a tax question for your CPA or for yourself is, what sort of capital gains are you going to be paying on that? Do you potentially buy some protection using options against your current position just as protection? Buy some puts just in case, or be ready to get out because it does look like Starbucks is getting weaker and weaker, and all of a sudden, especially over the last week and a half, it's just been brutal from 117 down to 103. Look, there's no shortage of people in line at the Starbucks by my house, but for whatever reason, possibly inflation due to the rising cost of coffee and transportation, that could be hitting them as well. So right now, Starbucks does not look good. Put a stop loss on it or protect yourself with options would be my 2 cents for you. Let's see. I'll go walk. Another quick question here from Lee. As oil gets to the $48 supply zone, what's the best way to trade it? Here's crude oil. You're coming right back into those all-time highs. I guess, Lee, you have to ask yourself is, how strong of a conviction do you feel that crude oil is going to sell off from here? At this point, it looks like it's going to break through those highs. It just feels like the overall trend is still intact and strong. Remember, I was bearish during this blue box, but it proved me wrong, right? And all of a sudden, you're still continuing that trend. So it may have some hesitation here, but I'll be honest, I'm not interested in shorting crude oil at that 84.50 mark. It just is a little bit too risky. Could you do it? Yes. What was the best way to do it? I'd say go to the futures market and just sell some futures against it. You could also go out and use some options on the futures or go to specific products like UCO or USO. There you go, NJ. See, and again, it's not that it's wrong to sell at that supply level. It's just it's risky because look how strong crude oil has been. Do I think it'll hesitate here? Probably. The question is how far down will it go? I don't know. So for me, I'm going to play this one a little bit more risk averse and move away from that one just because, that's just me. But that's how I would do it, Lee. I would be looking at the futures market, sell it outright. You could sell some options on the futures or go to the ETPs, exchange traded products like USO. Right, here's your oil fund, which is already up through that high. You have UCO, which is a leverage long position. So this is a double long. And there's probably some double shorts I can't think of off the top of my head. Big F says $100 by June on crude oil. Yeah. Hell, it could be $100 by... It's not that far away, right? I agree with Big F. I think you're probably going to see the continuation of this trend to the upside in crude oil and thus, making it a little bit risky. So that's cool. Just make sure you put a stop loss in place. Can you talk about that? All right. I don't think... well, let's look at this one. This is from Dorothy. It says, can you talk about the IYR chart? I'm long, and I'm wondering where to put my stop losses. We looked at this one yesterday. I don't know if you necessarily want to be long. Oh, it's from the bounce yesterday. We had that IYR bounce, that double hammer pattern. Not much of a follow through today on IYR, right? This is, I actually had an alert set up, but I overslept this morning, so I did not get into IYR this morning, but that was one I was on the list to look for. If you're long on this one, it's sending some serious mixed signals in my opinion. You have this double hammer formation down at the bottom, which tells me there's buying pressure, but today all of a sudden, the way we finished, the sellers were in charge. So really, you've got a pretty intense tug of war going on right here. Dorothy, you're going to have to answer that question for yourself as far as what's your stop loss and how much you're willing to risk. Ideally, you'd want, I don't know where you bought. If you bought based off of what we talked about yesterday, your stop loss should be pretty tight. I would not be using these lows per the example we had on the Russell 2000 yesterday. I would not be using these lows down around, 108.75. It just seems like a little too big of a stop loss on this one. But again, that each one is going to have a different risk profile. So I'd be very careful. That candle that formed today definitely showed some selling pressure near the end. And if that does carry through to tomorrow, you could see more downside movement. It's not a very pretty picture now that today's candle formed. I actually really liked it as of yesterday, but nope, gone. I lost interest. Oh, goodness gracious. I'm sorry, John. I don't know why I keep forgetting to switch screens over. So there's that picture I was just talking about. There's the double hammer, and then you have the shooting star this morning. Twice I messed up today. Man, I'm getting old. I've known Dennis for many years because he's an online trading academy student, and he was giving me a hard time about my gray hair, and I'm like, I know what little I have left. All right. Thank you, guys. I don't know why I spaced out on that one. Let's see. Aiden says, question, is there any tax regulation changes which we need to consider for this year, especially with crypto considering all the activity? Nothing yet, right? I still think that you're probably safest to be paying taxes like you would as a security and treat them as long-term capital gains or short-term if you're doing short-term stuff, but generally long-term capital gains. And I think it's important that you do pay taxes because the tax man cometh at some point and going to collect on it. So I've been trying to be above board and paying my taxes as due. Could you look at my crappy chart, Novax? Of course. Make sure I share the screen this time. NVAX. That's a crappy chart. Yep. I mean, it's just going lower. Hey, Chris. Thanks so much. I appreciate that as well. It was a good day for me over here on the show. If you look at the price pattern here, what I don't like is you see this low we had back here on October 20th. Well, you kind of ripped down below it. So if you were using this as an area of demand, it ripped below that. We could argue that maybe we put a supplies or demand zone down here. It's hindsight now, but this stop loss or the box would have been something like this. As you guys can see, I would have incorporated those lows, and then this one in theory would have taken you out had you been keeping it in line. So that demand zone that was there to me has been eroded, so that makes me feel a little less confident about it bouncing from here. If it does get down below that low you saw on January 6th, probably got to dump it. It just doesn't look good. It's really you've been kind of torturing yourself for a year. You've had some nice ups, but all of a sudden gives everything right back. I mean, and these are monster swings, by the way. This thing's down 50% in a month, less than a month. I mean, there's big swings in here. Novavax. This is why I don't trade drug stocks. I don't trade pharmaceuticals or drug stocks. Let's see. NJ wants TLT. Let's look at some short-term bonds. So there's your TLT for today. Right down into demand, bounced off it. Now the question for you is going to be, how high will this bounce go? Remember, TLT is the opposite of the yield. So I think that yields are going to be increasing. You guys saw my prediction or my forecast for the 10-year, 2.5% by the end of the year. Well, we saw a pretty big spike the first week of the year. We went up over 1.8. Now we drifted down to 173. The 30-year, which is more, I guess, representative of TLT. TLT is 20 years. This is the 30-year. It doesn't look as bullish as the 10-year, but if they're raising rates, this is going to rise as well. So as these rates increase, what you're going to see is TLT drop, right? As bond yields increase, the premium, the price drops. So that means that this demand zone down here, I'm just going to put a solid line right across these lows. To me, that actually does present an opportunity. If we get below there, a close below, let's say 140, 143, I think you got a short opportunity on TLT, right? That trend will be meaning up for the yields, down for the price of the bonds. I think TLT could potentially be a short opportunity here. So, this is something that they have in the portfolio of strategic investors. So be careful with this one. A lot of people are like, oh, bonds are safe, bonds are safe. Well, we are in a bond bubble. We have a situation where the Fed's been propping up the bond market, and now all of a sudden you're removing one of the biggest buyers of bonds in the world, the Fed. This could be the rug being pulled out of things like TLT. Look at the longer term chart here just to kind of put it into perspective. This has been since 2003. That's been a pretty significant move. This is bonds, right? It shouldn't really have that sort of volatility. It should be much more stable and calm. That's the whole point of bonds, is safe and stable. And getting you a nice rate of return. Well, this big swing we saw, especially the one starting back here in 2018, we went from 114 all the way up to 180. Incredible. Fluey, thank you very much. Welcome to the show. I don't think I recognized the name before, so Fluey, I appreciate that very much. You guys have been generous today. It's awesome. Is TLT the same as HYG? No, definitely not. So TLT is, you're looking at 20-year treasuries. So these are government bonds. HYG is high yield corporate. Very different, right? This is not a government product. This is, these can be very risky. And remember, the higher that rates get, so if we see interest rates rise, the less likely companies are going to be able to make their debt payments. So if all of a sudden rates get really high, the cost of capital gets real high, you could start to see companies defaulting on debt, which of course makes up part of HYG, right? It's a portfolio of corporate debt. Margaret wants to know about 3M. Best symbol out there. All right, so here's 3M. And Chelsea wants to go about nerds. Nerds are the best. I actually had a presentation today with a couple of super nerds. Jordan Matthews, Scott McCormick, myself, Darren Komodo. I'll look at that in just a sec, Chelsea. So here's 3M. Price-wise, it looks like that rock thrown into the water and it's having a big ripple. You had the big move up, big move down, and all of a sudden the waves feel like they're getting smaller. So I don't get any real clear direction by looking at the weekly. If I go to the daily, I'm feeling like short the rallies because I've got really since May of last year, lower highs, lower lows, so short the rallies on this one. I know it doesn't look great. I think that there's a lot of more attractive companies out there with regards to tradable price patterns. But long-term 3M is one of the cornerstones, I think. They're a fundamental portfolio necessity for any long-term investor. But the chart just doesn't look good right now. It just looks weak. So I would try to deploy capital in something that looks a little bit better. All right, nerds. NRDS. Nerd Wallet. Ugh. Chowski, you can analyze this one for me, man. What would I say? This thing looks terrible, right? Basically, you should do nothing with this until it breaks out of the yellow box. I'm going to just move it out here like that. This thing is stuck in a yellow box. So, Nerd Wallet's another millennial financial portal. There's a lot of them out there, but looks like they recently went public, or maybe it was a SPAC, I'm not sure. Nerd Wallet right now stuck in that range. So it looks boring, doesn't look like there's anything going on there. What's the volume like? Incredibly low volume. You have like 140,000 shares traded a day. I mean, that's real low. So not a lot of liquidity. It's just too risky. I personally would leave it alone. Chowski, there's a lot of other things that have better opportunity. Now, if you saw something like this that had good liquidity, you could sell options against it, right? And just do a spread trade. It's stuck in a range. Great. Stay in the range. Right now, it just doesn't look good. There's really no movement happening. And in theory, from a technical perspective, this pattern really says it should be going lower. Last one, MSFT. Microsoft. So Mr. Softy, as Mike McMahon likes to call it. Similar situation to what we just looked at with 3M, right? You had this gorgeous uptrend. Beautiful. I mean, and it's the thing with Microsoft is it's really one of the main leaders of this market to the upside. Focusing on DWAC. Oh, boy. This red line I just drew, that for me would have been kind of the proverbial line in the sand that I like to use, right? It was holding, it broke below it. So now my confidence in Microsoft is waning. It feels like it really needs to drift down here and move lower. So not a huge fan of this Microsoft chart. And again, Microsoft is kind of a heavyweight in the major market indexes. Microsoft's in the S&P, the Dow, and the NASDAQ. So something to keep an eye on would be the price of Microsoft and what happens going forward. But it looks weaker. And you notice a lot of these tech ones too. Here's Amazon, right? Amazon's been looking weak. Of course, you have the darling Tesla, which has been just tanking. Unless it's TS. It hasn't been tanking. TSLA. How about I get it right? There you go. Tanked a little bit from 1,200 down to 1,000, 20% drop, but still holding its own. You've got Netflix. I mean, Netflix just giving up the ghost. It was almost 700. Now it's 570 or 530. Again, big drops. Google. right? Holding, but rolling over. And I think this is what has a lot of people confused about the market or nervous, is that the tech component of our market is the most overweight. I believe it's like 22 or 23% of the entire value of the S&P 500 is just technology. So Scott McCormick did a great presentation today. If you have access to the symposium we did, I think it's up till Sunday for Online Trading Academy people. You can check that out. Scott McCormick and Jordan Matthews did just phenomenal jobs covering kind of where we are in the big picture thing. And technology is the piece that has Scott McCormick kind of nervous because it's so overweighted. If there's any hiccup in technology, as we're starting to see, right? Microsoft, we just looked at, you have Alphabet, Amazon kind of struggling. If that does continue, then you could see some big pull downs in the major indexes, which could trigger more selling. All right, I think I got it. DWAC. I haven't looked at DWAC, but just because you put it in there, DC or GD. DWAC. Oh, it had a good day today. Well, up to $70. I'm still just in shock that this thing actually has people buying it up at $70. But there you go, $70 today, up 11%. Not for me though. All right, I think that covers it. I think that pretty much got me covered. So let me go into what's happening for tomorrow. Here's what we have cooking for tomorrow. Economic calendar. The big announcement, guys, is going to be PPI. You can see the expectations are to go from 0.8% to 0.4%. I actually think that you're going to be higher than that. I think you're going to come out at probably 0.5 or 0.6% for PPI tomorrow. That's my estimate. Definitely higher than 0.4 given what I saw with CPI numbers. That's kind of your major news announcements. If you are trading the British pound, which has been on an absolute tear lately, if anybody's been following the British pound, David Warner would be proud. British pound, they have GDP numbers coming out tomorrow night. That'll be after we do the show. Also construction output and a whole bunch of other goodies. So that's the good stuff. I guess we do have a bond auction tomorrow. You can see we got the 30-year bond auction, so that'll give us some clarity as to demand for the 30-year and the long end of that yield curve. All right, that's it for today. Again, I'd like to thank the new peeps. Fluey says, got DWAC at 19, Trump plus evil social media equals profit. Yeah, right? Yes, it does. Or at least it means volatility. It'll be profit to a point. The key there, Fluey, is to not be the one holding the bag, because my guess is that there's going to be all kinds of issues with this thing going forward. So, lock in some profits when you got them, take some chunk of change and bail. How can you see the symposium? I believe if you go into my OTA, so you're a member, you go to my OTA, it should be in the archive version there somewhere. If you don't find it, let me know tomorrow and I'll see if I can dig it out for you. But I think it's up till Sunday. Some good stuff, some real good content. All right, everybody, that's going to do it for me. Tomorrow, I'm going to have Brandon Wendell on the show. We'll have Mr. Wendell joining us. David Warner will be on the show next Monday. And we will have Dr. Woody Johnson talking trader psychology on the show on Wednesday. So getting some guests on the program for you just to break it up a little bit and take some pressure off of me. So that's pretty much it. So if you guys have questions, comments, feedback, especially for you new guys, want to see different topics or want to get in touch with me, you can email me at TraderMerlin@gmail.com. Until then, happy trading, everybody, and I will see you all on tomorrow's show. Take care.